Hi, thanks for letting me be on again. Great to be here. What I'd like to do today is review the big picture for gold. You know, we've gone through a lot of confusion and turmoil and volatility over the short term in the gold market, really since late August as we've gone through this substantial correction in gold. And what I've been telling people is that the short term for gold, and really all markets these days, is much cloudier than the long term. And so I'd like to kind of summarize the points, the major points I've been making in a number of presentations and in Gold Newsletter recently, trying to get people to focus on the macro issues for gold right now because they are so powerful and so bullish for the metal. First off, I'd like to go to my second chart. Everything old is new again. This is a fascinating chart showing the silver content of the Roman denarius, with some words by Cicero here, that when he was kind of bemoaning the fact that things were getting out of control in the Roman Republic and Empire, in that debts were being built up and the government, the Roman government, was overspending in wars, military campaigns, bread and circuses, entitlements, etc. Sounds familiar, doesn't it? The Romans decided to devalue the currency. Now, even at this time, this was an age-old recipe in the face of unmanageable debts. Governments throughout human history have always devalued the underlying currency when the debt load has gotten too high to manage. So Romans were just doing something that the Greeks, the Assyrians, everybody before them had done when they got in the same pickle. Now, people say it can't happen here. It can't happen in the US. Well, frankly, it already has, and we're on a similar trajectory and have actually charted a similar path that they did in Rome. The purchasing power of the dollar has already lost about 88% of its value over that time period, really in the lifespans of probably most of the people listening to this. So it's already happened here. And it's going to continue to happen, as I'll show in a moment, and even accelerate right now or in the near future. As you can see in this chart, that decline has flattened a bit, but it's really going to take another burst to the downside, in my opinion. So let's look at what's happened. As you can see, we have this long red line showing the long decline of the purchasing power of the dollar. Let's look at what's happened with the long-term gold price over a similar time frame. Here you see a broad increase in the gold price from lower left to upper right that kind of mirrors the decline of the US dollar's purchasing power. But that really shows that people get complacent. And when you have those big upsweeps in the relative value of gold is when you see that the populace, where investors, where savers, have grown concerned about the underlying value of the currency. In effect, gold acts as insurance or as a buffer against this inevitable destruction of a fiat currency. So let's take a look at what's been happening recently to accelerate this trend that I'm talking about of depreciation. And I'm going to focus right here for the sake of time on really just one portion, important portion, but just one portion of this depreciation of the currency. And that's the creation of currency that we see. And we see here that the this chart of total Fed assets, you can see that there was a start to QE actually in August of 2019. The Fed didn't call it QE, insisted that it wasn't, but the market took it as QE. And we saw a corresponding response in the gold price. But then as the pandemic, as the COVID-19 pandemic hit, we see that real tremendous rocket shot in total Fed assets. Then there was a bit of a pause as a lot of swap agreements were repaid, et cetera, and repo issues were resolved. But we're back on the upswing now, and I think we're going to see even more of that to come post-election. Let's look at it from another standpoint, looking at the M2 money stock from the Federal Reserve's own charts. As you can see from this long-term chart, again, we have a parabolic rocket shot in M2. Monetary adrenaline, as you can see. Now, this should, by historic and classic economic understanding, immediately led to much higher inflation rates. But we didn't see that post 2008, and we didn't see that in COVID yet. Here's a view of why that hasn't happened, because the velocity of M2 money stock has plummeted. It started falling actually in around 2000. It accelerated its decline post 2008, and it's really fallen off the table now in post COVID. Now, why has this happened? Essentially, the post 2008 economic recovery was, as we remember, very slow and plodding. It was the slowest economic recovery following an economic crisis in US history. That was because there were a lot of other programs that were impeding government growth, regulatory state, et cetera, et cetera. Again, what we see post-COVID is that economic activity essentially shut down. That's why you see that very steep decline in M2 money stock. Now, what this implies is that once we have some restoration of economic activity, then this huge water balloon of liquidity overhanging the economy gets burst. And then if you see even moderate increases in the velocity of M2 money stock, money turning over in the economy, you're going to see some dramatic inflationary repercussions. I'd like to go over a few charts here that were produced in a really fascinating report, insightful report by Bridgewater Associates, in which they turned or expressed their very bullish views on gold. This chart shows the percent of global debt in local currency yielding below 1%. And as you can see, it's about 80% of global currency all over the world is yielding below 1%. What that means is if you're yielding below 1%, almost assuredly in each of these economies, rates are negative on an inflation adjusted basis. So this chart can really be interpreted as saying this is the extent of global debt that is yielding at a negative rate at this point in time. And as you can see, the vast majority of debt right now is negative yielding. One more chart we'll see from Bridgewater, the value of the world gold stock divided by the money printed by central banks. As you can see here, that has bottomed, but has recently turned up along with the gold price. If you look at where that peak was in 1980, between 4 and 4.5 to 1, you can see that that implies an increase of about 8 times or so from current levels, to get back to that previous high around 1980. There are a number of parallels. We're in basically uncharted territory right now with the gold price. We can't really look and see, well, there's resistance ahead because we've broken out into the clear. We've actually exceeded the previous highs. So you have to look back to broad parallels to try and get an idea of how far we can go. If you look at this chart and some other historic parallels, like the increase in the gold price from $103 in 1976 to $850 in January of 1980. If you look at the increase in the gold price from, say, $252 in 2000 to $1,920 in 2011, you're looking at increases of 7.5 to 8.5 times in a long-standing monetarily based bull market, secular bull market in gold. So if you look at that in this case and you apply a similar multiple, well, you have a bottom of the last bear market at around $1,040. If you had a similar experience where the gold price goes up 7 or 8 times, then you're looking at the end of the cycle at a gold price far, far higher than where we are today. And really, that's as far as I would like to take any kind of a price prediction, simply by saying it's going to be higher than you would think would be reasonable at this point in time. And the important point being that this is a long process, a new secular gold bull market that is still in the beginning innings rather. Now, to look at my last chart, what I'd like to show here is address the question, is the correction over now? Because if you look at the beginning of the chart, you have this dramatic decrease, fell off in the gold price as the pandemic hit. quick recovery of about $300, sideways action till the end of June, then another $300 rally, then a period where we were trying to digest and correct from that. So is the correction over? We'll find out. But if it isn't over right now in this instance, my view is that it will be over by probably mid-December. That's typically the time frame where the gold price bottoms or achieves an interim bottom, and then a new rally begins from there. So big lesson is the big picture, the macro picture for gold right now is set up to be perhaps as bullish as any time in our investing careers. And this is still the early stages of this long-standing, powerful secular gold bull market. It is a time to be positioned to buy dips, not to sell strength, but stay involved in this sector, but buy dips and accumulate gold, silver, and high quality mining stocks at what is still the beginning of this long-term secular uptrend. This slide shows me. Gold Newsletter is what I do. Goldnewsletter.com is our website. If you go to this link, goldnewsletter.com/report, you can get a half price offer to subscribe to Gold Newsletter. New Orleans Investment Conference is recently concluded, but you can go to our website and still get access to our club concept membership, where you can get all the recordings and ongoing virtual content throughout the year. And you can find me on Twitter. Thank you so much. I really appreciate the opportunity to present my thoughts to you today.